Coming up on the program today, Zimbabwe cuts world highest interest rate as inflation eases. And Egypt's central bank unexpectedly keeps interest rates unchanged for the first time since September. And Kenya's private sector activity jumps in January. Hello and welcome to Business Incorporated. I'm Will Ibang. Let's check in on the market, starting with Africa, where major equities were trading mostly with negative sentiment at intraday. The NGX was trading flat, 0.0%. While the GSE in South Africa traded up 0.17%. Meanwhile, the exchange in Egypt was closed in the negative on Thursday for the week, and the Nairobi Securities Exchange ended Thursday's session positively 0.02%. Over to the Middle East now, where most equities were closed for the week on Thursday, except the UAE. Abu Dhabi was down 0.01% on Thursday. Dubai was up, however, 0.43%. Now, still within the region, we see Saudi Arabia down 0.76%, and Qatari was down as well, 0.94%. Now, the European Central Bank continued to raise interest rates at record pace to fight inflation in the Eurozone. It hiked rates by another 50 basis points, pushing the bloc's key lending rate to 3%. Yes, Chris Kober with more from Berlin. Chris, despite inflation easing in the past months, the ECB explicitly signaled at least one more hike of the same magnitude next month. Why is that?
Because indicators are there that inflation is retreating from record highs, but it is still way above the ECB target. Inflation in the Eurozone stood at 8.5% last month. We did talk about this over the week, and the ECB's definition of price stability is an inflation rate of around 2%. And headline inflation has been in rapid decline, yes, since peaking at a record 10.6% in October. But core prices, which exclude volatile items such as food and fuel, have been rising at a steady or accelerating pace. That is why the ECB still had ground to cover. It wasn't done yet. Its president, Christine Lagarde, says the governing council intends to raise interest rates by another 50 basis points at its next policy meeting in March, and it will then evaluate the subsequent path of its monetary policy, the official statement read. Now, the ECB is also gradually whittling down the multi-trillion euro stock of bonds it accumulated over the last decade as it was trying to boost inflation, which was then too low.
That central banks are facing at this point in time?
There are two risks. First, the concern that inflation could flare up again. Right now, it doesn't seem likely, not least because that is the biggest worry of monetary policymakers. But should China's reopening or an intensified war in Ukraine push energy prices again, that would be a difficult situation. The second concern and the biggest risk is the persisting threat of a recession. For a long time, scholars in the United States even debated if inflation should be curbed at all without to the detriment of economic growth, rather. Now, the prime objective of central banks is to provide price stability, but they also aim to prevent a steep recession, regardless of how exactly their mandate is phrased. Now, in this regard, there is no real difference between the ECB and the US Federal Reserve, which, along with guaranteeing price stability, also has to keep unemployment low. So the task that many experts are identifying is to hold course while containing risks at the same time, meaning to keep fighting high inflation, but at a softer pace, which the Fed already indicated this week by raising interest rates by just 25 basis points, and at the same time communicating clearly to markets and trying to prevent any overreaction there, because too much optimism on the markets could offset the still necessary monetary tightening.
But the ECB is indicating that there are more rate hikes ahead. Nevertheless, stocks have been gaining. How does that go together?
That is indeed a critical issue. The ECB's president disputed markets' impressions that yesterday's move meant the hiking cycle was near the end. But it is the overwhelming interpretation, the wording in the official statement. The ECB would evaluate subsequent paths of its monetary policy after another rate increase in March, has many analysts believing that the ECB was opening the door to either a pause or a slower rate hike pace. So it'll be interesting to see how the European Central Bank is going to manage this anticipation in the coming months. After all, clear communication, as we said, is a major part of monetary policy. As of now, markets in Europe are banking on a more dovish approach, which pushed the DAX to its highest level in almost a year on Thursday, and which is also helping stocks post gains today.
Thanks so much, Chris Kober, for that update. Chris Kober from Berlin joining us. Now move over to stocks in Asia Pacific, where it traded mixed on Friday as shares of Adani Enterprises plunged and last traded 15% lower, continuing a sell-off triggered by allegations raised by short seller firm Edinburgh. Hong Kong's Hang Seng Index fell 1.2% in its final hour of trade in mainland China. However, the Shanghai Composite fell 0.66% and the Shenzhen Components lost 0.63% as the Caixin Purchasing Managers Index shows service activities in China picked up in January. The Nikkei 225 in Japan rose 0.39% and the Topix traded 0.26% higher. In South Korea, the Kospi also rose 0.47% to 2,480 points. In Australia, we see the S&P ASX 200 rising 0.62% to close at 7,558 points as investors digest new housing loan commitments for December that fell 4.3%. Now, stock futures slid on Friday morning after several high-profile earnings cast doubt on the recent market rally. Futures for the S&P 500 lost 0.86%, while NASDAQ 100 futures fell 1.65%. Dow Jones Industrial Average futures were down 0.34%. Struggles of major tech stocks weighed on the market. Apple and Google parent Alphabet both missed estimates on the top and bottom lines for their December quarters. Let's get more from yesterday's close from our correspondent, Maria Bird.
The U.S. stock market closed mixed on Thursday, as the Dow Jones was slightly down at 0.1% down. The S&P 500 was up at 1.5%, and the heavy tech NASDAQ took a strong close at 3% up. It is clear that many investors are still experiencing a rally from Wednesday, after the Federal Reserve announced that it was going to slow down on interest rate hikes, only increasing by 25 base points. It is also clear that the U.S. stock market seems to be rallying after what is expected to be a strong earnings report. It is clear that the U.S. economy may be looking toward an upward swing, and this could have a positive impact on the U.S. stock market.
Now, stocks in oil prices made modest gains in early trade on Friday, but we're headed for a second straight week of losses as the market looked for more signs of a strong recovery in fuel demand in China to offset looming slumps in other major economies. Brent crude futures rose 0.2% to $82.33 a barrel, while U.S. West Texas Intermediate WTI crude futures gained 0.2% to $76.06 a barrel. So far this week, Brent has dropped by 4.8%, extending a 1.1% loss from the previous week. WTI has fallen by 4.5% after sliding 2% in the prior week. Mixed signs of a fuel demand recovery in China, the world's top oil importer, has kept a lead on the market. Now we'll move to the metal space where gold prices steadied on Friday after a sharp sell-off in the previous session as traders digested rate hike remarks from global central banks. But the metal was set for its first weekly drop in 7 amid a strong dollar. Spot gold edged 0.2% higher to $1,916.31 per ounce after shedding 2% in a sell-off on Thursday that was fueled by a firmer dollar and profit-taking. U.S. gold futures were little changed at $1,915.80. Global central banks that raced to raise interest rates last year amid soaring inflation are now laying the groundwork in unison for a pause that, while not yet promised, is coming into a view for later this year. The US dollar, meanwhile, was up 0.1%, keeping a leash on gold prices. Elsewhere, spot silver rose 0.3%, while platinum fell 0.1% to $1,020.51. Palladium ticked up 0.1% to $1,655.60. Now, with the current disruptions experienced by Nigerians from PMS queues and ATMs as demand for new naira rises, speaking earlier today, Mr. Iniobong Usen, head of research budget, says the negative impact of these disruptions will be felt in the economy as Nigeria continues to battle rising prices. He was a guest on Business Morning earlier today.
Now, in access to the naira, you go to an ATM now. If it's an ATM that you use, your bank, you're only able to withdraw 2,000 naira. If it's an ATM of a bank you don't use, you're only able to withdraw 1,000 naira. Now, if you juxtapose that with the fact that only about 45% of Nigerians are banked, meaning that the larger bulk of the population is unbanked and do not have access to financial services. In my local government, for instance, there is no bank. And the only access people have to financial services are through the POS operators and maybe the agency bankers, as the case may be. But as we've seen over the last couple of days, it's been very difficult even for the POS operators or the agency bankers to access the naira, whether the old or the new. Now, what happens to economic activities in that particular local government? Everything would be brought to a halt. People who have their produce, perishable for that matter, cannot sell, and you lose all of that. Who pays for that? And so it's made the life of the average Nigerian unbearable.
Still in Nigeria, the Controller General of the Nigeria Customs Service, Colonel Hamid Ali, retired, is recounting how the nation lost over 400 billion naira owing to insecurity, especially in the northeast in the year 2022. According to him, the targeted revenue for the Nigeria Customs Service for the year 2022 was 3.1 trillion naira, but however, it achieved 2.6 trillion naira last year.
Into 3.01 trillion this year, but because of so many factors, variables that came into play, we were not able to make that. We made about 2.6 trillion. So this shortfall of 400 plus trillion is due to a lot of factors. One, the border issues took a share of it. The fluctuation of the naira took a share of it. The fiscal policies that kept giving sometimes waivers and concessions has a chunk of also part of that. And also some of those approvals that were given and enacted by the law that we didn't get the chance to commence collection. Like for instance, the carbonated drinks tariff, which up to today we have not started collecting. The telecommunication tax, which we have not even commenced collecting. Though they are in the act, but some bureaucracy have not really gotten us to commence collecting. So if you put all these factors together now and look at what we are given, then you can now come to a conclusion that the sheer amount of money that would have come to government is out there.
Welcome back. Zimbabwe's central bank has cut its key interest rates for the first time since becoming the world's most aggressive monetary authority in June. And this is on expectations that a downward trend in inflation will continue. The Monetary Policy Committee lowered the rate to 150% from 200%, making it the second central bank on the continent after Angola to lower borrowing costs this year. Matt Kindiger, practice lead Sub-Saharan Africa, Frontier View, joins me to discuss what this means for the economy going forward. Good afternoon, Matt. It's good to have you on the program again.
Hi, good afternoon. Thanks for having me on the program today.
Matt, this interest rate cut by the central bank, this massive cut, does it signal an improvement to the inflation outlook for Zimbabwe?
Yeah, so this is a good question because, as we know, Zimbabwe has been suffering from triple-digit inflation for a while now again. So its second major bout of hyperinflation in its recent history. So in summary, yes, it does suggest that the inflation outlook for Zimbabwe is improving, but I will emphasize that the inflation outlook still remains very high for the country, especially by global and regional standards. And we are still a long way from Zimbabwe seeing an environment of stable and low inflation. In terms of the outlook, in terms of the data, in our view, inflation has peaked in our view. Inflation fell from about 285% in August last year to around about 220% in December. And the outlook is also more positive. So we are expecting an average of 130% in 2023. So it's more than a halving of the inflation rate over the course of this year. The fall is likely going to come from a number of policy changes that we've seen in the country. So there has been the issuance of gold coins as part of legal tender, which has helped liquidity in the market. But also the government has tried to reduce money supply in the market, so to prevent some inflationary pressure there. And we're also probably going to see a bit of a stabilization and growth in exports from the country over the course of the year as well. So although inflation is falling and things are looking more positive, it is worth emphasizing that inflation will remain in hyperinflation territory for at least the next year.
That's good news and bad news, but we'll see how the government policies and reforms in that country help to make this better. Zimbabwe is also gearing up for an election in July. What impact will it have on the country's commercial landscape?
Well, the election certainly will have impacts on the commercial landscape in the country, and unfortunately, most of them will not be very positive. We are expecting a period of social and political unrest in the country as the election nears. Zimbabwe's recent history of elections has been marred by violence, and we are expecting this election to be no different. The opposition did quite well during municipal elections in 2022, and we do think that it is a relatively tight election, so it will be a tight election, so it's quite difficult to call in terms of who will be the victor. We are expecting, unfortunately, a rise in political violence. We've already begun to see this several months ahead of the election. So businesses certainly will face some disruption, at least. In our view, there will be some operational disruption, some route to market disruption for businesses, some supply chain disruption. So we would expect there to be a pretty difficult period for businesses. Consumer sentiment, business sentiment will decline around the election. So a lot of uncertainty in terms of the impact of the election over the next 6 to 12 months.
So given this high inflation and election uncertainty that you just pointed out, where do you see opportunities emerging for the private sector this year?
Yeah, so it's actually a very good question to ask, because even though inflation is very high, the election does generate uncertainty. The outlook is not all bad in Zimbabwe, and actually there are lots of industries that are doing quite well in the market. So, for example, we are expecting to see productivity in the farming industry to continue to improve as a result of some new investments, but also some government policies aimed at improving productivity. There's also been, there also will be improving prospects for the mining industry. So we are seeing very high global commodity prices boosting exports. There's also going to be increasing domestic capacity for the processing of locally produced minerals and metals. We're also expecting to see steel production to ramp up very substantially in Zimbabwe this year. And there's also been a very positive change in the way that the gold mining industry will be contributing to economic growth. So the country suffered for a long time from the illegal export of gold via the black market. This process has largely now been formalized by the government, and so this will contribute to formal exports growth for the country. So certainly a very positive development. So even though there are a number of challenges in the economy in terms of inflation, the election, we are still seeing a number of industries doing quite well.
Thanks so much, Mark. There have been some forecasts that economic activities, or the momentum, is meant to pick up in the second half of this year. We'll hope to see this happen. And East East African countries are meant to lead this charge. But we'll see how that pans out later. Thank you so much, Matt Kindiger, practice leader, Sub-Saharan Africa, Frontier View, for joining us today.
Thanks very much.
Now, Egypt's central bank unexpectedly kept interest rates, still on interest rates, unchanged for the first time since September. The Monetary Policy Committee maintained the deposit rate at 16.25% and the lending rate at 17.25%. The central bank says it is monitoring the effects of last year's cycle of monetary tightening on the inflation that's at the highest since 2018. Now, the Federal Competition and Consumer Protection Commission and the Egyptian Competition Authority have signed a memorandum of understanding to promote trade fairness between both countries, according to a statement by the management of the FCCPC. The key mandates of the FCCPC include protection of consumers and protecting fair competition in Nigeria, with its scope of application to all undertakings, conduct and commercial activities having effect within Nigeria. The process began in 2019 when the FCCPC and the ECA initiated discussions on enhancing competition law and policy between both parties. Now, Kenya's private sector activity rose for a third consecutive month in January. The S&P Global Kenya Purchasing Managers Index, PMI, went up to 52 points in January from 51.6 a month earlier. A survey carried out showed it was boosted by improved business in agriculture, manufacturing, service and wholesale and retail sectors. And that's it on Business Incorporated for this week. I'm Will Ibong. Thanks for watching. See you next week.